George Boubouras is Executive Director and Head of Investment Strategy and Consulting at UBS Wealth Management. George, what do you make of the numbers today? Happy with it?
Yes, clearly happy, clearly in line on the Q-on-Q number. And as Heidi suggested, there's some clear revisions there on the year-on-year number, 2.7 versus the market expected average of 2.3. The key here is that clearly Australia finished 2009 in a very robust fashion, and it's beginning 2010 in likewise very robust fashion, as those retail sales indicated. So when you want to do the breakdown, we know that the mining sector and the capital investment, both by Australian companies and the private sector and offshore, is quite strong, and it's the large 10 projects in Australia really driving that capital investment in the resource sector. And also the public sector, we know government stimulus has added quite a bit and it's probably contributed about 1% to that quarter number. The detraction from that number would be the net exports. Clearly, when you have a booming resource sector, you need to import capital equipment. And that sort of drags the net export to a negative. But the high Aussie dollar in the past 6 months has come to assist and make those capital goods cheaper to invest in that sector. But the point being is it's quite robust. It's not even, but it's a good start to 2009 with those partial indicators that came out earlier this week with retail sales.
Let me jump in here. You expect the momentum to pick up. The question is how strong? Where do we go from here? How fast will the economy grow?
Yeah, we see that the calendar year 2010, the Australian economy in real terms will grow around 4% with risks to the upside. Following those numbers just released, we'll probably see that calendar 2009 will finish for Australia around about 1.2 year on year on an annualised basis. And that's quite robust. Obviously, Australia did not have a technical recession, just had one negative quarter, and that was December 08. So we see that the earnings and the economic data bottomed in the middle of 2009, and it is quite robust. If you look at the EPS in the Australian market, and you look at it particularly with the top 100 stocks, it's very much a V-shaped recovery. We've got great earnings momentum, and it is true that it's been focused on the resource sector and energy and materials, and also the large banking sector where they've clearly over-provisioned and got some spare capital there, and they're well placed going forward with their margin growth. But as with the macro indicators, when you've got low unemployment rates, it really is a key driver for other sectors, and this is where consumer discretionary and consumer staples have been good performance, and we expect them to be. So robust backdrop for 2010, economic growth 4%, risks to the upside, and good earnings growth and momentum picking up as the year progresses.
George, Heidi here in Sydney. Just if I can interrupt, you talked about a V-shaped recovery, but Australian stocks so far this year, they've been fairly mediocre. We've seen the ASX 200, for instance, down 3% this year, and that's in line with India and Singapore. So why are you talking about a V-shaped recovery when really on the stock market we're not seeing any evidence of this yet?
Yeah, that's true. On the price side, clearly, and a price for the equity market is a very forward-looking indicator. It's the ultimate sentiment indicator as well as you're buying earnings in the future. And you are right, Australia's down 3.5% year to date. And interestingly, over the past 6 months, it's up around about 7.5%, where the US S&P 500 is up twice as much. Therefore, we say there's some great opportunities in value in the Australian market, because if you take a step back, we have the EPS revisions bottoming in 2009 and picking up. The reporting season that's just completed in Australia confirmed that earnings are growing from that low base and will accelerate throughout the year. And one has a look at earnings growth backdrop. You have to look at the real economies growing, we say 4% in calendar 2010. And when you add CPI to that, that's the nominal rate. So you're around about 6.5%. That is what earnings should trend in the economy, in the equity market. It should reflect that. And earnings have been negative for the past 2 years. So the backdrop is quite good going forward for good earnings growth and that opportunity. Hence, our forecast for the ASX 200, when we're putting these portfolios together for retail investors, is a 5,300, 5,450 in Australia, which is a 16% gain from today before the 4% dividend. So we're seeing that momentum again, Heidi, that EPS is picking up.
So a 16% gain, is that, are some industries going to be better performers than others?
Of course. Clearly, energy is the major recipient of this major, huge capex inflow. I mean, let's just look at Gorgon. You got Chevron, Exxon, and Royal Dutch Shell promising a $42 billion spend in a 2.5 year period in one of the largest LNG projects on the planet. I mean, that's just an enormous, and that has obvious consequences for many other stocks in the local market, like Adelaide Brighton and Boubouras and the like. And the infrastructure spend required is good for long products divisions like One Steel. So it drives a lot of the market, and it will continue to do that. But there is some impairment out there at the moment, and the property sector is still working through. For example, commercial real estate. There's no large-scale projects in Australia for office towers. The last office tower that's near completion is a $670 million building for the head office of ANZ in Docklands. And that's pretty much it at the moment. There's no real pipeline for significant spend. So there's not an even spend across the economy. Therefore, revenues and earnings won't be even across the economy. But resources and banks are going to benefit the most. That flow-on effect to some of the infrastructure stocks like Asciano and some of the building stocks like Boral and Adelaide Brighton. And then it can impact some consumer discretionary like JB Hi-Fi or David Jones or Reject Shop, for instance. So it has spin-off effects, but it's not an even growth rate, and also with the public sector spend. So it comes down to your portfolio will be performing based on sector and stock specific, and clients need to be cognizant of that when investing.